All right, we're going to look at a tool. It's a chart. It is the US dollar index, also known as the DXY because of its call letters DXY. What can the DXY show us? Well, one thing it can show us is how much it costs to purchase US currency from international currencies. When the US currency costs a lot to buy, we will see things like the stock market often come down in response to that. In this way, you can say it's inversely correlated. Why is that? A lot of US companies on the stock market do business internationally. So they're, say they're doing business in Canada, they're selling their products in Canada for Canadian dollars. They then have to get that money back to the US, and if it costs a lot, they're going to get less US dollars, which means those companies will report lower earnings. Lower earnings lead to investors giving lower value to stocks and companies. For our sake, the DXY is good for establishing some sort of general trend to give us a way to anticipate which way the market might go. We compare the DXY to the stock market on a new price scale. You can see that there is some correlation, but that correlation varies. Here's a peak in the DXY, and here's the stock market having its lowest point. Right here, we have the rise of the stock market as the DXY is coming down. DXY starts going up, stock market's coming down. DXY is coming down, stock market's going up. DXY is going up, stock market's also going up. Well, what does that mean when it's not correlated? It could just mean that the DXY is having a suppressive effect on the stock market, or other forces could be having a greater impact on the stock market at the time. The stock market is much more susceptible to things like hype. Investor sentiment can be impacted a lot faster by news, but the DXY and the US's standing with other countries can also be impacted by news. If you see a long, a high time frame trend of the DXY going up, question whether or not you're going to see the value of your assets come down, right? You can see from the stock market, it's had a very determined, steady rise. The DXY has just been consolidating. When you break this trend here, it comes up, it comes down, retests, and goes up, well, we could be in more upward territory. And you can see we've already explored through this area. So what's going to happen if the DXY comes up to here? From here, I might start to apply some bias and say, I think it's going to come down. And if it comes down, I'm going to be looking for asset values to go up, right? And if it's something like Bitcoin, which post-halving typically enjoys its massive bull run parabolic phase, if the DXY keeps climbing, you might see Bitcoin consolidate for a few months. And then when DXY tops out, people start to apply their expectation, and then the DXY comes down, well, then all the people who were waiting for that sign change of direction, then start to get into equities. You don't know that's going to happen, but you just kind of play these scenarios out in your mind and try to ask yourself, well, what can this tool do to inform my investing decisions, right? Not just when to get in, but when to get out. If you are down here, it wouldn't have been the best time. Like you can see the stock market continued to rise. So this wasn't necessarily an exit trigger, but it might be a reason why when you got to this point, you started to at least look closer at it and either validate or invalidate other theories about what direction investment and equities are going to take. Don't ever rely on this alone to compare to investment and equities. Every tool just gives you one more ability to look at the market to ask yourself questions about what you think is going to happen and what your plans are going to be.